welcome to the Real Estate and Urban Economics program of the 8th Annual ABFER Conference. Good morning in Asia and good evening in the United States. My name is Stan van Nieuwerburg and I'll be your chair today. So our first session of the program is on climate risk and real estate. We're going to have 4 exciting papers on this topic. And the first paper is called Climate Risk Perceptions and Demand for Flood Insurance, and will be presented by Dr. Venugopal from the University of Central Florida. You have 30 minutes, and then afterwards we'll have 10 minutes for discussions. For the audience at home, please use the Q&A window to ask your questions. You could do that during the talks already. I'll collect these after the discussion, and the last 10 minutes of each session we will have for Q&A. So with that said, let's get started. Please go ahead and share your screen.
Hey everyone, can you hear me fine and see the slides? All right.
Yes, that looks good.
Yep, thank you. Good morning to those in Asia and good evening to those in the US. I'd like to start by thanking the organizers for getting a paper in the program. And apologies beforehand if you hear a baby cry. I have a 6 weeks old in the background. So this paper is joint work with Dimuthu Ratnadiwakara, who's at Louisiana State. As the title of this paper suggests, we are trying to relate how climate risk perceptions affect the demand for flood insurance, both at the intensive and the extensive margin. So we all know that flood risks are increasing. The year over year, the number of floods as well as the severity of floods have been increasing. And flooding is the costliest natural disaster according to various estimates. And roughly 41 million Americans are exposed to 1 in 100-year events. And this severity is actually expected to grow based on studies in climate change, the global warming. Because of it, the number of floods as well as the severity of floods are expected to increase in the coming years. The policymakers have been drafting a lot of laws. I'm from Florida, so I'm sitting in Florida, and we have an above average storm season coming in. And Florida just passed its Always Ready bills, which basically puts together a resilience fund. And a lot of other activities happening in the policy space also. And on top of it, the industry is also taking notice. Essentially, everybody is trying to at least tackle this particular problem, right? So when it comes to tackling flood insurance is considered to be the low cost and the most effective way or adaptation mechanism, right? It helps property owners to minimize the losses that they are facing as well as recover quickly. And there has been already studies showing this. The only game in town when it comes to flood insurance is the National Flood Insurance Program. They actually write nearly more than 90% of the policies that were issued in the US. The private market is actually pretty small for flood insurance for various reasons. The flood insurance is actually divided into 2 parts based on the area. So if you're living in an area that has roughly 1% probability or more of getting flooded, then you're classified into something called as the special flood hazard area. And everybody outside of it is called as the non-flood hazard or SFHA area, right? The flood insurance policy works as follows. So NFIP gives a maximum building coverage of $250,000 and contents coverage of $100,000. For those living in the high-risk area, that is the SFHA area, for them, especially if they have a mortgage, then flood insurance is required. It's mandated by federal law. Whereas content insurance is just voluntary. For people living outside of this high-risk area, both building and contents coverage are voluntary, right? And on top of this, flood insurance premiums are heavily subsidized, right? The average subsidized flood insurance is roughly about $482 for the maximum coverage, as well as including the contents coverage. And you can get subsidies up to 45%, even if you're living in a high-risk area, depending on various calculations, right? We are not going to get into the discussion about whether this is a good idea to subsidize flood insurance. That's not the point of the paper, but we are sort of sidestepping that particular entire issue. However, it makes sense to at least try to understand whether flood insurance makes sense for most of the households. So in order to understand this, what we have done is we have taken an average household and looked at the ACARA utility and by plugging in the average wealth, the claim and other numbers. And on average, an average US household has roughly $75,000 in wealth. The mean flood insurance claim in case of flooding is roughly $40,000. And if you're living outside of the SFHA area, then roughly 1.4% of the policies make a claim. The average flood insurance is roughly $470. Right. So what you can see over here is that whether you go through the wealth, or whether you go by the probability of flood damage, or whether you go by the expected loss, flood insurance sort of makes sense for most of the people who based on this particular simulation. Right. And having said this, the main thing that we observe in the data is that flood insurance take-up is actually pretty low, right? Since 2000, the left figure over here shows the number of flooding disasters that have happened across the US. So, and another point to be made is that flooding disaster is not just a coastal problem, it's across the US. Whereas if you take a look at the flood insurance outside of the coastal areas or the special flood hazard zones, the flood insurance take-up is only 5% actually, right? And overall, the flood insurance take-up is still around only 12%, which is much, much lower compared to what you would expect, right? So why is flood insurance take-up so low? And what are the factors that determine this particular pattern over here? The literature has come up with a few reasons. People have said that salience is an important factor. Garriga actually shows that flood insurance demand increases after every disaster. There's another new paper by Hugh who talks about salience. And there is also a set of papers which argue that public disaster assistance discourages actually flood insurance take-up. And there is another set of argument that it may be expensive or there's some cost involved over here, right? So what we are doing in this paper is basically we are trying to figure out whether climate risk perceptions or your personal beliefs impact your decision to take up flood insurance or not. Right? If you think about it, flooding disaster is essentially an extreme tail event, right? And there is an entire literature that talks about how people evaluate these tail events, and and most of the papers actually say that there is a subjective probability weights that people assign to these tail events. And that subjective probability is based on their beliefs and risk preferences. So famously, we have the Tversky and Kahneman paper, as well as Carmen and Kuhlman. They have also discussed this in a different context. So what it means in this context, in the flood insurance context, is that if you as a person don't believe that climate change is happening, or if you don't believe in the concept of global warming, then you are more likely to assign a low subjective probability to flood damage. You're more likely to think that, okay, I'm not going to be affected by this flooding event. And if that is the case, then you are not likely to take up flood insurance, right? So essentially what is going to happen is that if you believe that flooding is not a big issue and climate change is not a big issue, then the market is not going to take up flood insurance, right? There's going to be low insurance take up. And this would probably come based on your risk perceptions, actually, right? So what we are doing in this paper is we are using the flood insurance data from NFIP, and we are merging it with the data from the Yale Climate Opinions about beliefs about global warming. And we are trying to show that individuals' beliefs about climate change is positively related to flood insurance demand, specifically in the non-SFH areas, that is the lower risk areas. And it is positively related to the probability of carrying contents coverage in high risk areas, that is the SFHA area. And you are more likely to choose the maximum deductible, or put a different way, you are more likely to, or negatively, it is negatively related to the choice of your deductible. In other words, If you don't believe that climate change is a real thing, then you are, even if you take up flood insurance in the SFHA area, then you are more likely to choose the maximum deductible in these cases. And on top of it, we also show that climate change skeptics would not actually renew their voluntary flood insurance after an exogenous increase in flood insurance premium. I'll get into the details a bit later on, but just to give you a bit of context, in 2012, the flood insurance premiums went up, and we actually saw some of these climate change skeptics drop their voluntary flood insurance coverage. Right? So just to give you an idea about the data sources, our on 49 million policies that were in force between 2009 to 2019. We have the premiums that these guys paid, what was the effective date, what was the coverage, whether they had contents coverage, their flood zones, a lot of information is over there. The beliefs data come from the AIL program on climate change. Here, we are able to look at each county and figure out what is the percentage of people who believe that global warming is happening, who personally think that they are worried about global warming, or if they think that it is personally harmful for them. And these surveys actually happened in waves. And we also collect a lot of other data from the American Community Survey. This is primarily used as controls. The data from this is primarily used as controls for demographics and income. We have the FEMA disaster declarations, and we get average home prices from Zillow. And we are going to use the elections data, which I'll talk towards the part of it, to look at how perceptions change with elections. Right? So just to define a few key variables before we go to the results, our entire analysis is conducted at the census tract level. Right? A census tract roughly has anywhere between 2,500 to 8,000 people. And we define flood insurance take-up as the number of active policies divided by the number of homes in each census tract in each year, right? And we define the low risk areas, that is the non-SFHA areas, as areas or census tracts that have less than 5% of high risk policies, right? And we have three variables that capture climate risk perception. The first is happening, which is essentially the fraction of adults in a county who believe that global warming is happening. I'm going to focus more on this particular variable, the worried variable. That is what I'm going to use throughout this particular presentation. That basically tells you what is the fraction of adults in a county who are worried about global warming. And finally, personal is essentially people who think that global warming can harm them on a personal basis. Right? So we have formed three different analysis samples over here. We first look at the areas, that is the low risk areas, and study the take-up rate over there. The low risk areas, or the non-SFHA areas, are roughly 17,000 census tract panels, right? The take-up rate over there is only 4.5, right? Whereas 54% of the people think that global warming is, they are worried about global warming, right? And the cost of flood insurance, after all the discounts, is roughly $231 for every $100,000 in coverage, right? The next the next panel that we are using is the high risk data. This is the SFHA census tract year panel, and roughly 19,000 census tracts fall into this particular category. And out of these, 38% of them, 38% of the policies have contents coverage, and maximum 33% chose maximum deductible. And the average cost over here is $742 for every $100,000 in coverage. Right? We also have a panel to at the policy level, policy year level, to understand who actually drops out from their coverage after prices go up. Actually, I'll talk about towards the end of the presentation. Right. So just to start off, what we observe in the data using a very simple OLS test is that take-up rates actually increase when the number of people in a particular census tract are worried, when more number of people in the census tract are worried about climate change, right? So essentially we are running take-up with take-up rate on the left-hand side, and we have divided the worried group into three buckets. actually 4 buckets. The first bucket is people who are less than, who fall under the less than 25% area. And what you can observe over here is that the more number of people who are worried about climate change in a particular census tract, the higher is the take-up rate, right? You can see a monotonic increase over here, right? The first one, we don't have any controls, but even after controlling for all demographic factors, race, education, population, cost of flood insurance, a host of other factors, we see this monotonic relationship there, which essentially says that if more number of people in your census tract are worried about climate change, then the census tract on the whole would have a higher take-up rate, right? So that is for, that is for the low risk areas. So this is the area where flood insurance is not mandated, right? Now let's take a look at where flood insurance is mandated. So in the SFHA areas, that is the high risk areas, you have to have a flood insurance if you are carrying a mortgage on your home. So over here, the main variable that we have to consider is the contents coverage and the maximum deductible. So we have the contents coverage on the left-hand side. And again, we observe that there is a monotonic increase in the number of people who carry contents coverage if the perceptions about climate change actually increase over here, right? And the same thing is true even if you're looking at maximum deductible, right? If you have more number of people in your census tract worried about climate change, then the less number of people are going to take the maximum deductible, right? It goes in the opposite. So again, we are controlling for a bunch of factors over here at the census tract level. And we are also controlling for the state year fixed effects so that we are comparing units within the same census tract, sorry, within the same state year. So all of this is fine. But there are some identification concerns over here. As you can imagine, perceptions may be correlated with a lot of unobservable factors, right? So yes, since census tract and state year fixed effects try to rule out some certain alternate explanations, and it helps us in controlling for time invariant non-observables. But the fact that we cannot control for all factors, that is, there are a lot of unobservables in this particular setup that are time varying, actually poses a very important consideration for us when it comes to identification, right? And the bias this introduces is also difficult to ascertain, right? The coefficient could be upward biased or downward biased. It could be upward biased by people's past experiences. If you have experienced flooding in the recent past, then you're more likely to take up flood insurance. If there are children in the household, then again, it seems that people are more likely to take up flood insurance. If you're more aware of the risks of flooding, then you're more likely to take up flood insurance. However, on the other side, if the house has any structural, difficult to ascertain also. So what we are doing here is we have two different identification strategies, right? We are going to exploit the heterogeneous impact of partisan polarization around climate change beliefs, especially after the 2016 election, as an instrument, right? That's one of the strategies that we're using. It's essentially an instrumental variable estimation, right? The second one is we are going to use the sudden increase in flood insurance premium in the year 2012 with the Bigger Waters Act as a shock to the system, and we are going to look at how people change their behavior, right, to identify the impact. So let's start with the IV over here. So this is basically a picture of how people perceived climate change starting from 2008 to 2017. And the dark red line over here shows how the perceptions of conservatives changed. The blue one shows how the perception of liberals changed over a period of time, right? And what you can see is that there has been a widening partisan polarization. And what we are arguing here is that the 2016 election acted as a catalyst to widen this partisan polarization, and the 45th administration actually had a lot of role to play in that, right? This is just some examples of what the 45th president said over a period of time during his administration. And he has been quite popular, as you can imagine. This is just a picture of his Google Trend mentions. So anything that he says has been highly noticed by people, right? And what we are going to use is the share of Republican vote gain in the 2016 election as an instrument, right? So essentially what we are doing is we are looking at comparing the 2012 election with the 2016 election and looking at how much gain in support has the Republican candidate, 2016 candidate, got between these two elections. And we are going to use that as an instrument for the years after 2016. Right? So essentially what we have to understand is that that particular instrument is relevant, right? When people are more and more polarized, right, the number of it actually has a direct impact on their climate risk perceptions. In fact, a 10% gain in by the Republican candidate actually leads to a 2% drop in the number of people who are worried about climate change, right? So essentially what we are running is a simple IV regression. We have on the first stage, the instrument, we are instrumenting for worry, and we are taking that and looking at what's happening to the take-up rates. And as you can imagine, the impact actually is almost the same. In fact, what we have observed is that the coefficient has been slightly downward biased. In other words, the take-up rate actually has climate risk perceptions, has a lot of impact on take-up rate, and the widening partisan polarization has an impact on climate risk perceptions, actually, right? So to give you put an economic magnitude to this, a 1 standard deviation increase in worried leads to an increase of 22% increase in the take-up rate, right? And if you look at contents coverage, that is areas where flood insurance is mandated, again, we would see that a 1 standard deviation increase in worried, the number of people who are worried about climate change, leads to a 32% increase in contents coverage, right? Which is a large number if you think about it, right? And finally, with regards to the maximum deductible, you can see that a simple 1 standard deviation increase in the number of people who are worried about climate change is associated with roughly 14% drop in the number of people who choose the maximum deductible. So what we are arguing over here is that your political affiliations has an impact on climate risk perception, and that in turn impacts the decisions that you make for this adaptation behavior, whether you take a flood insurance or what, do you have contents coverage, or do you choose a maximum deductible, right? So that's one way of actually identifying our results. The other one is using a sudden increase in the premiums right around the year 2012. So NFIP, the program as a whole, has been in debt. It has been a lot of financial troubles. So to solve that, in 2012, the Big at Waters Act was launched, which essentially increased the level of premium for a large fraction of the households. So this is just an example of how premiums have increased comparative to 2011, right? So the premium increases started coming in from 2013 for most of the households. And if you are actually a person who does not believe that climate change exists, if it's not a big issue, then you're more likely to terminate your flood insurance, right? With respect, whenever there's a premium increase, right? So remember that we are in the high risk areas. Oops, sorry. In the high risk areas, you are mandated to have flood insurance. So therefore, if you are going to cancel your flood insurance, you're more likely to do it after the premium increases over here, right? So how do we actually look at this? So we are looking at the fraction of people who terminated their flood insurance, and we are looking at whether they were worried about it or not, or the census tracts were worried about it or not. And what we observe is that right after the premium increases, we saw the number of people who are canceling their insurance increase, right? And it sort of went up again, or become insignificant in 2016 because the policy was reversed, and we see again a response by the people over here, right? So essentially what we are trying to say over here is, in this particular paper, is that climate risk perceptions play an important role on how people actually perceive the the damages that they may face, and therefore they may choose flood insurance based on those perceptions, right? And for identification, we exploit the political side, the widening political partisanship around climate change, and we identify the impact of climate risk perceptions. And we also use the exogenous increase in flood insurance premium. And we argue that people who believe that climate change is happening, they are more likely to take a flood insurance, whereas on the other side, climate change skeptics or deniers are more likely to terminate even their voluntary flood insurance over a period of time. Right, that's pretty much it. Thank you.
Thank you, Eshwar. Thank you, and right on time. We have a few extra minutes for the discussant. So Carlos Garriga will discuss the paper. Carlos, if you could share your slides, please. You have 10 minutes plus 2 bonus minutes.
Okay, let me start. Well, thank you so much for including me in this wonderful session and allow me to discuss this paper. It is certainly an important topic, and these are just now my views, but the chief economist of Freddie Mac about 5 years ago pointed out that these may just be, more than just, a shock. This may be more of a rising trend in which, increases in the level of rising waters near the oceans, will leave potentially households departing those properties and unpaid mortgages, and this could be a redux of what we saw in 2007, potentially raising all kinds of concerns. People that live in Florida, like the case of the presenter, and I used to live in Florida, we have witnessed that, we have, hurricane water damages and flooding, and this is something that has been increasing in the last few years. So certainly, this is an important topic. The trends are kind of macro. We see these, gradual increases in sea levels. These flooding episodes have become much more predominant, not only in coastal areas, as the presenters have pointed out, but also in areas that see, raising levels of, water as the snow melts. It is an important issue here as well in Missouri. So there's plenty of evidence that's not just a kind of a micro question, but a very important macro question. And central banks across the world are worrying about it. Certainly, the Federal Reserve is thinking about all these issues. The macro implications of that, as well as implications on financial markets and macroprudential. So the paper starts with the observation that despite the risk that exposes many individuals, in particular homeowners, not many enroll in these programs, despite the fact that these programs are heavily insured. So one of the questions is, why are these individuals not, taking insurance? The classical, way to address this question is the thinking that maybe what's going on is that the price of insurance is too large, but this is an insurance that is heavily subsidized. So the argument that the price could be an issue does not seem to be the natural candidate to start. So the authors are going to take an alternative route to try to answer this question. They're going to try to assess to what extent the perception of risk is something that it really affects the demand for insurance. So what they're going to try to address is to what extent, if these individuals have a bias in the likelihood that global warming is causing a risk of flooding, to what extent that might keep them from entering in that market, or if they do enter in the market, because in some cases they've been forced to, because they have a partner in the purchase of the house, they buy the minimum amount of insurance required. So in their mind, basically, they think that a potential explanation for this important question is those biases with respect to global warming in general, which is highly correlated with flooding levels in coastal and non-coastal areas. So in order to answer this question, the authors basically, they try kind of a combined approach. They will start with OLS, but they'll soon switch to an IV approach where they'll try to measure areas in which these things are mandatory, flooding insurance is mandatory relative to others that they're not. And they try to see to what extent individuals purchase different quantities of insurance based on on this perception that this is a real threat or not. They find in their empirical exercise that the intensity of the homeowner's opinion, at least on the tracks that they're studying, that global warming can help to explain the observed holdings in insurance purchases, the amount of coverage chosen, as well as, according to their estimates, the level of flood preparedness. They identify that, especially in areas with high flood risk, these homeowners are taking the mandatory insurance, whereas individuals who don't worry about global warming are less likely to purchase these, content insurance that's going to protect their items inside the house. And they're also more likely to, and this is something that was not discussed in the presentation, but this is something that discussed in the paper, that those individuals that are less worried about global warming, what they seem to try to do is basically prepay their loans in response to changes in insurance premiums to not have to make those payments. As I mentioned, this is an important topic, so I found at least it was useful in my mind to kind of frame it in a standardized model like the one the author presented earlier in the introduction. And what I guess it was just kind of missing in their presentation in the standard demand for insurance is the fact that those individuals may have some subjective probability relative to the actual ones. They may put a bias on what is the likelihood of facing risk. So what I've done here in this slide, basically, I presented the standard problem in which there's a likelihood of facing a loss. An individual has the option to purchase an insurance to protect the loss, where P is the price per unit of insurance. And this is the standard thing, and pi is the actual probability of facing, non-facing the loss, and 1 minus pi is the probability of facing the loss. And then the delta represents the subjective probability. So this is just kind of the deviation that is tied to each individual view of the world. And one extreme view would be that this is all a climate hoax. Therefore, an extreme bias would be one in which you completely offset all the risk that there's floating out there. The optimality certainly is affected by perception. So the standard problem gives you an optimality condition for demand that is going to basically balance what is the risk and what is the price of insurance. And then in this framework, what you do find relative to the standard framework is that even when insurance is fairly priced, your perception is going to affect whether you are going to be overly insured or you're going to be underinsured. And I think this is essentially what the authors are going after. I mean, there is, at least in my mind, a way to try to rationalize. So if you have a bias, even when you think that the insurance is fairly priced, you may choose not to purchase. Now, they also use a variation argument in which they assess to what extent changes in the price of insurance did also affect the demand for those that didn't have a perception. One can think that the changes in the price of insurance are connected to the change in the underlying risk. So if the price kind of moved one for one with the changes in risk, one would perceive that even when things are fairly priced, then those individuals that may have a bias may be buying less insurance than they should. And that's entirely driven by the bias. So in some sense, this is just a framework that tries to assess those biases. One of the challenges is that we don't really have a way of map those individual expectations with particular holdings of insurance. These are measurements that are calculated as a percentage at the track level, and this is one of the limitations. So there's no direct connection between the insurance policy variables that are analyzed at the household level to the expectation that individuals have at a particular census tract. But I mean, it would be ideal to have the data that would allow you to connect those individual expectations with these insurance holdings. But in any sense, the equation that would connect the expectations with the holdings would be the one at the bottom. So this is certainly a very interesting topic. And what it tried to do, basically, you think about it, we're using a framework that is often applied to something that we often, call idiosyncratic risk, at least in the macro literature, which is where I'm coming from, to something that would also be defined as aggregate risk. And certainly what we do know is that often idiosyncratic risk does not affect asset prices, in particular house prices, but aggregate risk may. So I think one of the challenges one moves, forward with this type of analysis is just to what extent the insurance holding in some things that affect things that respond to aggregate shocks are now pricing into the value of the asset. So in a sense that in some other, in some areas we have basically homeowners that are not buying insurance. It's not clear that the lack of insurance holdings, they're trying to protect the structure, may not be capitalizing the price. If you know that in this area, houses are going to be constantly flooded, then it may be the case that the property relative to a similar property in an area that is not prone to risk nearby may have substantially lower prices. And then one of the issues as well might be the fact that, when you have situations like that, coordination issues could be potentially affecting prices in general. When homeowners understand that if they do purchase the house, they may get some protection, but if all their neighbors are not buying, insurance, it could be the case that, buying insurance might not be the optimal thing to do if the whole area is going to be abandoned, because that's going to drive the price of the property down, even though the property could potentially be fixed. So this is just something that I think is worth keeping in mind. I think we saw some of that with, the case of Sandy in New Jersey. Something that I think is equally important is, and that will touch the last two comments that I want to make relative to the paper, is also related to asset prices, right? And that was discussed in the presentation and is extensively discussed in the paper, right? But in certain areas, it's mandatory to have insurance if the property has a mortgage, because the lender does not want to get exposed to risk, and the insurance is supposed to protect the collateral. But we do know that, this insurance has some caps up to, $250,000, which in some cases may not replace the value of the structure. So if you think about what is the effect of insurance in the prices, well, I mean, you can think about developing a fairly standard asset pricing equation in which if you don't have insurance, the potential resale value is affected by the likelihood of the property flooding. If the property value gets completely wiped out due to flooding or has a partial, value, here I just assume that it was zero, then, prices should be substantially lower. If the homeowner buys full insurance, you can protect the value of the property, so the homeowners face lower disposable income, but they know that the resale value can be painful. So I think if one had micro data, it would be ideal to potentially test those perceptions in individuals who don't really have a mortgage, because in their cases, the demand is not really biased by the necessity of having a mortgage. Now, the problem is, as I mentioned earlier, it's really hard to measure the expectation in the data that the authors have available at the individual level. So they need to rely on what is the average type of expectation at a particular census tract over time. The last comment, I think that's just an important issue. This is something that it certainly affects areas like Florida, and it did certainly affect California, is to what extent this insurance is only protecting part of the value of the house, measuring the structure, but not so much in land. And I think when we're talking about flooding, a key element that gets exposed to risk, it's land, not just the structure. So when we think about a more general theory of housing that not only includes the structure, but also includes the land, some insurance can certainly protect the structures, but in the case of flooding, you can be facing a situation in which after the flood, the land becomes unavailable to put an additional structure on top of it, which is something that we saw in 2019 in California, in the Montecito area with the mudslides. What happened with that episode is that insurance companies paid the value of the structure, but the value of the structure was a small percentage of the value of the properties, because essentially what gave a lot of value to this property was, the land where the physical structure sat on it. And basically the insurance company paid a market price for the structure, but the homeowners were unable to rebuild the property because the land essentially disappeared. So obviously that generated a loss of collateral. If the property had a mortgage, it also generated welfare loss. So this is a situation that certainly does not seem to be one that may be protected with flood insurance. And this is one of the issues that I think is really important to think as we go forward. There's really flood insurance is going to protect situations in which the land is going to be, unavailable to produce housing services. So these are just some of the things that kind of were motivated by reading this paper. And I think it would be fantastic if the outsource could, somehow tie the connection between insurance holding and one of the underlying prices in some of these areas that may be more prone to risk relative to similar areas that do not get exposed to that risk. Thank you very much.
Thank you, Carlos, for those great comments. Okay, so we have a few minutes for Q&A and for questions. So maybe I will give the first a couple of minutes to respond to Carlos's discussion.
Thank you. Thank you, Carlos, for a wonderful discussion. I really appreciate it if you could send the slides. It was really helpful, especially when you put that in the form of a framework. So yes, as you mentioned, we are limited by the data that we have over here because our climate perception data is at the aggregate level, and we are trying to relate it to insurance at a very micro level. But definitely your point is well taken. We'll try to relate or at least figure out what's going on at a micro level. There are a couple of questions on the chat, if I can answer them.
Sure, let's do that.
Yeah. So I think Deborah asked, is there a short way to look at how, depending on the regional exposure, what is happening with climate risk and flood insurance? We have tried something of this. We are still working on it. But to say it in a very short manner, what we find is that even when we are looking at very small regions and compare it with other regions with similar exposure to climate risk, the perceptions play an important role over here. So even at the census tract level. And the other question was from Luhan. So her question was about whether we are worried that the attitude towards climate change also affects political beliefs and whether it makes the instrument itself endogenous. We were worried about it, and that's one of the reasons why we actually tried looking at the price increase, the sudden change in prices, and still we find the similar results. So I think the results are still valid at that point of time. And finally, Ishita had one question on is there a way to self-insure by actually taking a large mortgage and owning less of a home? I really wish there was a way to do this. We did try and take a look at the loan-to-value ratio from the Hyundai data, but we still don't have a clear idea about that, but definitely the point is well taken. We are taking a look at it.
There's also a question in the Q&A, and I wanted to remind the audience that they should type their questions in the Q&A box if they have any. And the question is, if I'm not mistaken, catastrophe futures and options exist for catastrophe risk management. Why not look at these option implied probabilities to see what probabilities the market assigns to these extreme climate events?
Oh, okay, that's actually a pretty smart idea. I'll definitely take a look at it. I don't have an answer for that, actually. We didn't take a look at it, but we'll definitely take a look at it. Thanks.
I also had a question for you. We know from the literature that the actual event of climate risk realizations often raises the salience. Is that something that you have explored potentially as an instrument?
We actually used it as a control. So we looked at, that's a Garriga paper 2014, where they look at recent floodings raise the salience. We actually use as a control, and we still find the results to be there, that the climate perceptions is actually affecting the flood insurance take-up rate. But we didn't explore it as an instrument. That part we have not done, actually.
And maybe one more thought, kind of more big picture, the question is, is there any way to affect people's awareness, or, some of your, instruments suggested that this was highly correlated with political beliefs, but that could suggest that it's kind of an immovable attribute, right? So to what extent is there hope for raising awareness?
Actually, we have been thinking about it on how this. You're right, because it's sort of a tribalism kind of thing. If you think about it, people dig into their heels especially when it's politically affiliated. So there is a recent study by the insurance industry, which basically says that the way to get at these people is by explaining or at least showing how much damage they would incur without a flood insurance. And there was a very small survey, and it seemed to work. What we are offering in this paper is we are trying to pinpoint areas that would be susceptible to these kind of marketing, actually. So I think that's one of the contributions that we can make in this particular study.
Great, thank you very much.